I want to know when you say market neutral, because I don't think when
Mm,
you say market neutral that it means what many of the people who will listen to this podcast think it means. So what did it mean back when you were doing it, in late 2017? What does it mean today? How does it differ from arbitrage and some of the other strategies that you guys are running?
yeah. So, yeah, you can define market neutral more or less strictly, and I think like the answer is it does and it doesn't. Like there are pure market neutral strategies that you can run in crypto today, and I think people. It's really interesting because I think the general perception is that these markets are far less sophisticated and deep than I think they actually are. People are always surprised by the amount of instruments and the amount of trading venues. Um, but yeah, like market neutral. What we do in the factors fund, which I run, is more properly called beta neutral. So we have no directional bias in the portfolio, but at a given point in time, we will be taking directional market risk with certain strategies that we run. But like the core of what we're doing is arbitrage, kind of HFT, market making, and you'll have some inventory risk there. But on the pure kind of RB side, your most simple trade in the space in the market neutral is in a bull market you can long spot short the perpetual, and you get to collect a funding rate. The perpetuals in crypto are like a CFD or a swap from the traditional space. So every 8 hours you have this kind of settlement, and you're basically getting paid for providing dollars into the market, like taking the other side to someone who wants to be levered long in crypto. But that's a as long as you're kind of hedging your payouts, that's really kind of a very pure, simple kind of market neutral trade that you can put on and hold. Basis trading is pretty much the same, so all that usual kind of cash and carry type stuff. Market making for me is still I still consider market neutral because they're like oscillating between plus minus 2 to 5% net exposure, depending on the day. So that's you're taking very little market risk there, and then you sort of branch out into these more sort of stochastic strategies where they're predicting where a particular coin is going to go, and then they're taking directional risk, long or short, on a some time horizon. So your traditional strategies is like long short CTA, which for us is much less interesting than the shorter time horizon, much higher turnover, kind of short duration, kind of long short trading, momentum, statistical arbitrage, things like this. And what you have in those strategies is, yeah, at a given point in time, they might be long or short the market 10, 20, 50, 80%. But they're going along in 1 hour, short the next, and they're typically doing it across a bunch of different assets. And at a portfolio level, their exposures are sort of hedging themselves out because when they're long some Bitcoin, they'll be short some ETH, typically, and that's not always the case. So these are, you need to be very careful. We kind of think of these as like Ferraris around the racetrack. They can do wonderfully well when the sun is shining, and then when it starts raining, it starts to skid, and you want to be careful and kind of take your foot off the gas. But they can do very well, but you're taking certainly more kind of market risk there. But over a period of 2 weeks or more, in the kinds of things that we're allocating to, they're not correlating to a crypto market cap, for example.